So something pretty big is brewing in the Indonesian stock market. A global financial giant, MSCI, has started raising some serious red flags. And this isn't just some routine report either. It's a specific warning that has everyone from investors to regulators paying very close attention. The question is, what's really going on here? So let's just dive right in. You gotta ask, right? Why would a heavyweight like MSCI, a company whose indexes literally guide trillions of dollars in investments around the world, suddenly put Indonesia under the microscope? What did they find? Okay, so first up, a warning from a global giant. To really get to the bottom of this whole thing, we've got to start by understanding the warning itself. Think of it as the first major clue in this whole financial puzzle. Now, what's really fascinating is that this entire kind of complicated issue, it really just boils down to one key financial term. And that brings us right here, to the key to the mystery, free float. This is it. This is the key to this whole thing. So, what on earth is free float? Well, put simply, it's the chunk of a company's shares that people like you and me, the general public, can actually buy and sell on the open market. It doesn't include shares that are locked up by insiders or the government. And for a company like MSCI, this number is absolutely critical. It tells them how much of a stock is actually tradable. Let's look at a really simple example of how this is supposed to work. Let's say you have a company with a market cap of $20 trillion. If they report a 20% free float, you'd expect $4 trillion worth of shares to be available for trading. It's just straightforward math, and it's the number that big index funds rely on. But, and this is a huge but, that's just how it's supposed to work on paper. This is where things start to get really interesting, which brings us to the illusion of circulating shares. Because what's reported, well, it isn't always what's real. So here's the problem that MSCI is flagging. It's a practice where the shares are effectively being dried up from the market. I mean, that's such a great term for it. It's like the pool of available shares is just evaporating, leaving way, way less than what you see on paper. And this chart? Wow. This just shows you the massive disconnect. A company might report a pretty healthy-looking 20% free float to get into an index. But in reality, the actual amount of shares you can go out and buy might be as low as 1%. The rest, they're like ghost shares. They're on the books, but they're not really available. So how do they pull this off? How do they create this illusion? Well, it's basically a sophisticated shell game using something called nominee accounts. The original owners park their shares with their friends or affiliated groups. So on paper, it looks like these shares are out in the public, but really the original owner is still pulling all the strings. Okay, so you have to be asking, why go through all this trouble? What's the end game? Well, that leads us right to the motive, what our source calls the game behind the price. And believe me, it really is a game. So here's the playbook step by step. First, you dry up the stock to create scarcity, basic supply and demand. Second, with very few shares floating around, it's incredibly easy for the people in control to push the price up. Third, they manage the trading carefully, a little buying here, a little selling there, to create this perfect, steady uptrend on the chart. And that beautiful chart, well, that's the bait. And that bait leads to the ultimate goal. The source puts it perfectly, saying the trend becomes, quote, attractive for many investors and retail who want to take a shot. In other words, you make the stock look so good, so much like a sure thing, that regular investors feel like they absolutely have to get in on the action. Now, while riding that wave up might seem like a good thing, it's a huge, huge problem for the big global players. And that brings us to our final section, why MSCI is concerned. Let's break down exactly what has them so worried. For MSCI, this whole situation is flashing three giant red flags. First, there's a total lack of transparency. No one can see the true picture of the market. Second, there's the illusion of liquidity. It looks like the stock is easy to buy and sell, but it's not. And the biggest fear of all, they're worried their funds will become the exit liquidity. That means when the manipulators decide to cash out and take their profits, they'll be dumping all their shares onto the index funds, who are then left holding the bag as the price completely collapses. So when you pull back the curtain and see everything that's going on, when the number of available shares is just an illusion and the price is being carefully managed, it forces you to ask a really important question. In a market that works like this, who truly holds the control?